Sure, I think that the FOMC statement was very much what people expected, and that is it had three components to note. One is that the Federal Reserve noted that the path of the economy is dependent on the virus. Secondly, it noticed that the virus has been increasing. And thirdly, I'd say the Fed indicated it's prepared to do more and that monetary policy will remain easy for a long time. And so I think that these things together, I think the logic, like if you look at these as like a logical argument, I think it leads to the conclusion that the Federal Reserve will take more action at the September meeting. That's the next time they meet. At the end of his prepared remarks, Powell also admitted, he acknowledged that the Federal Reserve's review, their bigger policy review, he said is nearly over. And so that also sets us up for to announce the end of the policy review, the conclusions of it, and that just lends itself to new action. So I think that the logic is that the economy still needs help, the COVID virus is still growing, it's got economic impact, and the Federal Reserve will do whatever it takes for as long as it takes. Well, I don't know if they'd go to negative interest rates. I still think that is a very low likelihood and for a low probability in the U.S. I think instead could do a couple things. One is indicate that because how high unemployment is, and we're going to see this next week, that the unemployment level is still above the peak of the great financial crisis. And so I think the Federal Reserve is going to try to link its policy forward guidance to some macroeconomic variables. Unemployment's got to be falling or got to be at such a level, or, for example, they might do that with inflation, saying because inflation's so far below 2 for so long, it might be willing to allow inflation to go above 2% for a period of time. I think all those things aren't really material, but they're about forward guidance, showing how serious the Federal Reserve is. Another thing they could do is and here's the challenge really, is that in March and in April, all these large Fed actions were really meant to help stabilize the markets. Now, the Federal Reserve has to shift gears from stabilizing the markets to reviving the economy. And so that might be a quicker expansion of its balance sheet. It might be yield curve control. It just seems to me that we don't know exactly what the Fed's going to do, but we know the direction it's going to be moving. And that's why I think that as the FOMC statement, before the FOMC statement came out, the dollar was really pinned on its session lows. Say a little bit around 117.70 against the euro, 129.5 against sterling, just above 105 against the Japanese yen. And as the market saw the statement and heard Powell's comments, they took the dollar higher. The dollar got above 130 against the British pound for the first time since earlier this year, made new highs against the euro made new highs against the dollar, rising above 118. Well, we came pretty close to $2,000 an ounce already, but I think that we're going to have to probably go through there. Partly because what I'm thinking is that this big dollar cycle that we're in, where the dollar rallied for almost the past 10 years, and now it's turning down. And if we're in the early stages of the next dollar down move, and gold is already at record highs, I have to imagine that gold is going to go through that $2,000 level. And it's hard to know where it's going to go, really, because we've never seen these levels before. But I can see how, if I can imagine a 10% move, say, on the dollar against the euro, that would bring us up to, say, 130 area. That would tell me gold should be able to rally 10%, which should take us up to, say, 2,200 or so. Yeah, so I think that most people regard what happened in Q2, and so that covers that second quarter. We get April, May, and June, and the economy, it's really like, not just in the US, but Europe is the same kind of story, where a very sharp contraction, but very sharp, but very short. So already by late May, there began being signs of recovery. So I think what this means is a couple things. One, yes, the second quarter GDP is probably the worst we're going to see, but I think that it's really old news tomorrow when we get it. As soon as we get it, because investors, like policymakers, are forward-looking. We're getting close to the middle of Q3. So Q2 is more historical. What we really want is higher frequency data for July, and I think we're going to get that, and that's why next week's employment number is so important. Besides that GDP number tomorrow, we're also going to get weekly initial jobless claims. And remember last week, unexpectedly initial jobless claims rose a little bit, they might rise again.